A lot of investors buy a rental expecting freedom, then end up stressed because the property keeps taking money out of their pocket instead of putting money in it, because nobody taught them the financial side of protecting profit. These are the 7 fixes that can completely change how your rental performs. Reason 1, reconciliation. If you have transactions coming out of your bank account every day, reconciliation is a must. Reconciling is the procedure of writing all your transactions down in your books and matching it with your bank balance. That's just like back in the 90s when you first opened up a bank account. You were giving maybe some blank checks and then it came with a check register. And you were told anytime you spend money or you receive money, you make note of it. And then you match that with your bank balance. So with your check register, as you're writing your transactions, you're also updating your balance. And if your check register says you have $78 in your check register balance, then your bank balance says you have $100. That's how you know that you're still waiting on things to clear. That's reconciliation. Here's where it gets risky. When you're not recording or you're trying to remember which transactions that are still outstanding, such as your rental income, a payment, or a check that you have written to a contractor. These unrecorded transactions can lead to a financial disruption, such as overspending, return checks, and failed ACH. Here's a helpful hint. Start by either using QuickBooks Online or a spreadsheet. Make note of every transaction that you do, whether it's coming in or it's going out. If you can't do that, then anytime you make a transaction, take a picture of the receipt and then record it later. And every week you should be categorizing all of your transactions to label them and to find out exactly what money is still outstanding or what are you expecting to come in. And then every month you want to make sure that you're reconciled. Reason number 2, categorization discipline. As previously mentioned, you want to make sure that you're labeling your transactions. You want to make sure that your repairs are not mixed in with renovation costs. Owner contribution is not categorized as income. Owner contribution is you putting money into the business bank account so operations can run. And income is what you would get from your tenant. That would be your rental income. You also want to make sure that you're separating your personal transactions from your business transactions. Also, you want to ensure with your mortgage payment that you're separating it 3 ways. There is your principal, your interest expense, and then also your escrow. The interest expense is going to go on your profit and loss because that is an expense. Your principal payment is going to go on your balance sheet and it's going to go to pay down your loan. And then your escrow is going to be as an asset until it's time to pay your property taxes or your homeowner insurance. Then once you make the payment, then it becomes an expense. With your short-term rental platform fees, you want to make sure that they're separated properly. Whatever the gross is and then deducted expenses such as your cleaning, you want to make sure that you have all of that recorded and all of that separated. And lastly, if you flip houses, you want to make sure that you're keeping your materials separated from your office expense. If you don't have categorization discipline, that's almost like putting the milk in the pantry. You're not ensuring that things are going in the right place. And that's exactly what happens if you misclassify a roof replacement and categorize that as an expense. Replacing your roof is going to be an investment. If it's categorized as an expense, you could suffer from having a loss on your profit report for months. So here's a helpful tip. Start by looking at your tax form. If you are using a Schedule E, you want to look at the expenses that it has for a business account and start with using those labels when you're categorizing your transactions. Number 3, you want to track your net operating income monthly. Your net operating income, or NOI, that's going to be your rental minus your expenses before your mortgage is taken out. For example, your rental income may be $2,000 and your expenses may be $1,200. That's going to leave you with an NOI of $100. That's going to be your foundation to let you know when you're reviewing your profit and loss and you're looking at your month over month. If you see that your profit is less than $800, it's possible that you have expenses that are spiking. Here's what you want to do. You want to make sure every month that you are reviewing your profit and loss. Specifically, you want to pay a close attention to your expenses should be consistent and manageable. Number 4, you want to keep your business separated from your personal. Most real estate investors only want to worry about carrying one card, but in the long run, mixing your personal with your business can get very messy. That's like taking your white clothes and mixing them in with your dark color clothes. one is going to negatively impact the other. This can result in a negative equity balance. So here's what you want to do instead. Once you have your EIN and your LLC, open up a business bank account and have a separate account, a card, strictly for that account, only for business transactions. In the meantime, before you actually set up your business account, make sure that you're recording all of your transactions so that when you do have your business account, you can upload all those transactions over to your QuickBooks Online. Number 5 is the vacancy model. The vacancy model is you planning vacancies expenses. That's like having auto insurance. You want to make sure if anything happens or when it happens that your expenses are covered. That's exactly what happened when a tenant leaves and your property is vacant for 2 months. You still have your bills coming in. You still have your mortgage. Now you have to pay for paint touch-up, repairs, and even cleaning fees. And you don't have any rental coming in. Having that planned vacancy expenses, money set to the side, will cover those expenses. That way you don't have to result into your personal funds, a loan, your credit card, or making panic decisions where you're making exception to your tenant screening, which if you get a bad tenant, this can cost you more long term. So here's what you want to do. Every time you get rental income, you want to take anywhere between 5 to 10%, put that into an account called vacancy. And that way, whenever your property is empty, you have money set aside to cover those expenses until you replace it with another good tenant. Number 6, expense ratio tracking. Expense ratio tracking is going to be your operating expenses divided by your effective gross revenue. A good ratio is going to be anywhere between 35 to 50%. For example, if your expenses total $2,360 minus your rental income of $3,700, that is a 64% ratio. That means 64% of your rental income is going towards expenses. So here's a helpful tip. Do these 2 things. Look at your profit and loss report month over month. Monitor your expenses to see if there's any spike in your expenses. And then also monitor your expenses to see if there's anything that you can negotiate to either stop paying on or reduce the amount that you're paying. A reserve policy is a rule or a procedure that tells you which type of reserve to put to the side and how much needs to be put to the side for reserves. Reserves are going to be your money set aside for unexpected expenses. The most common reserves are going to be vacancy reserve, CapEx, or either capital expenditure, which are your major repairs reserve, and then you have your maintenance and repair reserve. Your repairs are going to be your safety net. So whenever your tenant leaves and you have repairs or you are paying for a vacant property, your bills are going to continue. Your mortgage still needs to get paid. You have the repair fees, you have cleaning fees, and you also have touch-ups that you have to do to get your property prepared for the new tenant. Getting a new tenant in your next property can take anywhere from 3 to 6 months, and you have to make sure that you have money set aside to cover those expenses. So here's a helpful tip. Every time you get your rental income, take out 30% of your rental income, and you want to split that up between vacancy reserve, maintenance and repair reserve, and then also your capital improvement or CapEx, which is going to be for your major repairs. You want to make sure that you have 10% going into each. That way, when those unexpected expenses happen, you are covered with money on the side. If you're a new real estate investor or you try managing your own books and it's becoming too complex, this is exactly where problems start. I specialize in helping investors, getting their books back to good standing, identifying hidden risk and profit links, and building a system so you can scale with confidence and not guesswork. Schedule a diagnostics through my website for long-term rentals, short-term rentals, and flips.